ESG and socially responsible investing, SRI, encompass several distinct investment approaches, each with different objectives, implementation methods, investment considerations, and risk characteristics. While all approaches seek to incorporate sustainability considerations into investment decisions, they differ in how ESG factors influence portfolio construction and security selection. Some approaches focus primarily on improving risk-adjusted returns through better analysis, while others emphasize ethical alignment, sustainability themes, active stewardship, or measurable societal impact. Investors must therefore evaluate each strategy according to its intended purpose, expected outcomes, portfolio implications, and potential trade-offs. Understanding these distinctions helps ensure alignment between investment objectives, fiduciary responsibilities, sustainability goals, and client expectations. Full ESG integration involves the systematic and explicit incorporation of ESG risks and opportunities into security analysis, valuation, and portfolio management decisions. Unlike screening approaches, ESG factors are embedded directly into the investment process and complement traditional financial analysis. Portfolio managers use proprietary research, company engagement, quantitative tools, and fundamental analysis to assess material ESG issues. The primary objective is to improve risk-adjusted returns and identify long-term value creation opportunities. Benefits include flexibility, deeper analysis, and broader investment opportunities. However, full ESG integration requires substantial research resources, may be difficult to communicate through simple ESG metrics, and depends heavily on analyst expertise and judgment. Exclusionary screening is the oldest and simplest responsible investment approach. It excludes companies, sectors, or activities that conflict with specified ethical, religious, social, or sustainability criteria. Common exclusions include tobacco, gambling, controversial weapons, pornography, and certain fossil fuel activities. The primary objective is value alignment rather than financial optimization. Benefits include transparency, simplicity, and consistency with investor beliefs. However, exclusionary screening can reduce diversification, increase tracking error, create unintended factor exposures, and limit investment opportunities. Because it is largely rules-based, exclusionary screening may overlook companies that are improving ESG performance or engaging positively with sustainability challenges. Positive alignment or best-in-class investing takes the opposite approach by selecting companies with stronger ESG performance relative to sector peers. Rather than excluding entire industries, investors identify ESG leaders within each sector using ratings, scorecards, or proprietary assessments. The objective is to reward companies demonstrating superior sustainability practices while maintaining diversification and sector representation. Benefits include broad market exposure and encouragement of ESG leadership. However, results depend heavily on ESG rating methodologies and provider assessments. Different providers may identify different ESG leaders, and companies may still face sustainability challenges despite ranking favorably relative to peers. Active ownership, thematic investing, and impact investing represent increasingly proactive forms of responsible investment. Active ownership uses engagement, proxy voting, and shareholder dialogue to influence corporate behavior and improve ESG performance. Thematic investing focuses on sustainability-related themes such as renewable energy, water, healthcare, or climate solutions, seeking exposure to long-term growth opportunities. Impact investing goes further by intentionally targeting measurable environmental or social outcomes alongside financial returns. Benefits include the potential for positive real-world outcomes and alignment with sustainability objectives. Risks include concentrated exposures, measurement challenges, execution risk, and uncertainty regarding the achievement of intended environmental or social impacts. Other responsible investment approaches include ethical or faith-based investing, norms-based screening, community investing, and blended strategies that combine multiple techniques. Ethical and faith-based investors typically apply value-driven exclusions based on religious or moral principles, while norms-based strategies assess compliance with international standards such as human rights, labor rights, and anti-corruption frameworks. In practice, many institutional investors combine full ESG integration, screening, engagement, and thematic allocations within a single portfolio. Each approach offers unique advantages and challenges. The most appropriate strategy depends on investor objectives, risk tolerance, regulatory requirements, return expectations, sustainability goals, and stakeholder preferences. Effective responsible investment therefore requires balancing financial considerations with desired ESG outcomes and understanding the trade-offs associated with each investment approach.